Hi, everyone. It's noon, so I think we will go ahead and get started. Hello, and welcome to the RIS Step Up to Work Comp Success webinar series. Thanks for joining us today. I'm Kelly Marshall, and I will be your host for today's session. Just a couple of things as we get started here. As you've probably already all noticed, you've all been placed on mute. We will take questions during the session. You can use the Q&A function at the bottom of your screen to enter those, and we will address them at the end as time allows. So your host, your person in the hot seat, I should say, for today's session is Lisa Zessin. She is an underwriting supervisor here at RIS. She's been working with us for over 15 years in the insurance industry, so I'm fairly certain that we can't throw any questions her way that she can't handle. Thanks, Lisa, for joining us. Welcome.
Thanks for the invite, Kelly.
The goals for today are the following. We will talk a little bit about the significance of your EMOD and how that determines your work comp premium, summarize how an underwriter evaluates your risk, and then highlight some of the ways that you can effectively manage your own workers' compensation programs. So let's get started. Lisa, let's start with the EMOD. We sometimes hear words like EMOD, experience mod, experience modifier. Can you start by just explaining for us what this really means?
Sure. Yeah. So all one and the same, depending on who you're talking to, your agency, your underwriter, different carriers, they might be referenced different ways, but the experience modification is ultimately a tool created by your specific state rating bureau to predict whether an employer is likely to develop loss experiences that are better or worse than that of the average risk in that same classification. So this means you're comparing losses experienced by businesses of the same or similar type of industry. So ultimately, your fast food restaurants are going to be compared to your fast food restaurants. You're not going to end up getting compared to that of, say, like a long hauling trucking business. So the comparisons are made to like and similar exposures.
So is this like magical? Everyone just gets an EMOD, or how does an employer get one?
So not immediately, you won't receive an experience mod. If you're a new business venture, you have to meet some specific requirements. If you're an established business, you already have met those requirements. But ultimately, insurance companies report payroll and loss information on an annual basis to the Bureau. And there's a minimum payroll and premium requirement as well as length of coverage to qualify. Depending on the size of your business, you might qualify pretty quickly. Otherwise, you may qualify after 3 years of audited terms. There's a chance you may never qualify for a mod, depending on the size of your policy and payrolls. So it can kind of go back and forth. You may even qualify 1 year and not qualify a couple of years later, again, depending on the size of your business and operation. But loss history is reported to the Bureau along with those 3 audited terms of payroll, and then that is calculated to provide you an experience modification. Better performance in 3-year period results in a better calculation. Unfortunately, 1 bad year can also impact your experience mod for 3 years as well. So if you're performing better than the industry, then you're going to receive a credit modification. If you're performing worse than the industry average, you're going to receive a debit modification.
Okay, so I thought the premium was just kind of the premium, but now you're talking about credits and debits on the mod. Can you explain what that means?
Right. So when we're talking about the impact of claims on the mod, there's a difference between frequency and severity. So the cost of an accident is often less predictable than the fact that the accident even occurred. So there's greater weight to accident frequency than there is to accident severity. Statistically, what has been shown and told to us is that employers with 1 large loss are still considered more stable than those with frequent smaller losses. So a catastrophic claim may not hurt your mod as much as one would think due to split point factors that are used in the plan calculation.
Okay, split point. So underwriters and insurance in general already uses lots of acronyms, and now we're using more words that don't always make sense to a lot of people. Can you explain what that split point means?
Yeah. So the split point is one of those factors of the plan calculation, and it's related to losses. So the amount of any rateable individual loss up to the split point is considered the primary loss, which reflects frequency, and the excess of that split point is known as the excess loss and reflects the severity. So primary losses have a greater weight in the formula than the excess losses, and therefore they have a bigger impact or greater impact on your experience mod.
So basically what it sounds like you're saying is that it doesn't really matter after a certain point how much a claim actually costs.
Yeah, so you could make that assumption, definitely. Excess losses do have less weight, but they're still relevant because the total excess claim dollars can still be quite high. And like a catastrophic loss would be more impactful than one that isn't considered catastrophic. But overall, the impact of the losses is still not as severe depending on the overall excess. So say the midpoint in your state is $20,000. A loss of $25,000 with $5,000 over that split point is not going to impact your mod the same way that a loss of $100,000 would, but it's still going to impact your mod.
So basically, are you saying that it's better to have one big claim than a whole bunch of small claims?
So from the experience modification calculation, you could really, again, make that assumption. But overall, from an underwriting standpoint, we're looking at prevention as the leading factor to a strong experience modification. So again, another example to illustrate what we're talking about here. Say you have a known tripping hazard in a high trafficked area of your business, and you have employees that regularly slip, trip, or fall on that hazard and incur first aid only claims or small medical only claims. But with no action taking to that hazard, eventually you have an employee that slips, trips, or falls, and they have a severe injury, such as a broken hip. And that's pushed that claim over that split point, as well as incurred indemnity payments. So now you have the weight of that loss that plays a factor into the mod calculation and your underwriting review.
Okay, so I think I kind of understand what you're saying about how claim costs and the frequency overall of those claims impact the mod. But outside of just calculating the mod, what other impacts does that actually have on my work comp policy?
Right. So some other changes that can happen to your policy when it comes to your experience mod is that you're talking about your anniversary date, for one. So your anniversary date automatically follows your expiration date of your policy when you qualify for a mod. And if you were to move the expiration date of your policy, say you move from a 1/1 effective date to a 7/1 effective date on your policy, when your 1/1 anniversary date comes around, you're potentially going to see a change in your policy midterm because that experience mod has now developed based off of the anniversary date. So you go from 7/1 having the 1/1 mod applied to now we hit the 1/1 mod at the anniversary date and a midterm change comes in. So depending on what your mod was going to do, you might see an increase in your premium midterm, or you might see a decrease in your premium midterm. Then there's also short-term policies. So say you move your policy short-term, and most carriers are filed with their states and their bureaus to assess a penalty to your policy. So even outside of your mod, if you move your policy outside of the anniversary date or the current effective date, you could be assessed to that short-term penalty, and that's an impact to your policy as well too. And then there's things that you don't have control over, such as your anniversary date. So say ownership changes, which then can impact that anniversary date, because you've now moved your policy, which from an ownership change, you're not going to assess a short-term penalty because that's just the nature of business. You sell your business to someone else, but the new person that picks up your business may have your experience mod or be automatically approved for an experience mod because of the experience of the prior ownership. And so that plays a part in your overall policy as well too, because again, that anniversary date will have an impact. So there's just some things to be aware of, even outside of the calculation itself.
Okay, so the thing that everybody really wants to ask you is why you underwriters ask so many questions. So we already talked about lots of acronyms and terms that you use, but what we really want to know is why you're asking so many questions that seem very strange sometimes, like, do you own a company plane, or do you go to certain heights or depths? Why are you guys always asking us all of these different things?
Right. So it's definitely never the intention of an underwriter to ask unnecessary questions. We really strive for ease of business with our agency partners and ultimately our insureds as well too. So there really is a rhyme and reason to the questions that we're asking. And, ultimately we have to evaluate the risk. We have to understand what it is that we are writing based off of the information we receive from the agency, based off the information that the insured provides at the time of the submission as well too. And then we're also utilizing resources online that help us understand a little bit more about the risks and the exposures. So that's what our job is. And then you have reinsurance. So reinsurance is insurance for us as a carrier for the risk that we're writing. And there's certain things for every carrier that based off of your reinsurance agreement, you can or cannot write. So a lot of times the questions that deal with height exposures, depth exposures, aviation exposures, if we have an indication that those are present, there's certain guidelines that we can follow and can accept. And then there's things that fall outside of our acceptable guidelines. So perfect example in the case of RAS, if you're working at heights more than 3 stories in size, then that's a reinsurance exposure for us. And it's just something we can't offer a quote on. So those kinds of questions are really important for us to know and understand the risk. And then the reason that we ask the questions is because of the rating that we can apply to the policy as well too. So the mod has its own credits and debits based off of your loss history. But from an underwriting perspective, we also have some credits and debits that we're able to apply to a policy based off of the exposures that are present. So if you're a bit higher in the exposure than another, then you may have some debits applied to your policy. So thinking about, say a plumber, and you have a plumber that's doing new business construction. So they're working on the same job site generally, all day long or a couple of days, and there's a little less exposure than, your plumber that's just doing small jobs and, answering house calls on a regular basis. And so those exposures change a little different and factor into that rating information for us.
So we've talked a little bit about the mod and how that's impacted, how that then in turn impacts the premium, credits and debits, both on the policy, on the mod, and mostly it sounds like all kinds of questions and lots of things that can go badly. But can you tell us, as an underwriter and asking as someone who's an overachiever, how do we get from an A to an A+, for example? What do I need to do to get all the credits and get the best rates that I can?
Sure. So there's several things you can do, several things that we're looking at from an underwriting perspective that really demonstrate kind of the best of the best when it comes to your business. So love that enthusiasm, definitely want to write those kinds of risks. And although we're looking at these things, it doesn't always mean you're going to get the best credits, but it definitely puts you in the right direction. So things such as implementing and following a safety program, a return to work program, and your claims reporting as well too. And when I'm talking about a safety program, we're not just talking about, yep, I have it, but really what depth do you have in this? So do you have a safety coordinator possibly? Is your safety focused program from the senior leadership down, or are you involving all different levels of your employees to get and feel that safety focus on a regular basis? Are you reviewing it often with your employees, or is it just something that you check mark at safety orientation or new hire orientation? So really demonstrating that proactive approach to safety is part of that A+ rating. Same thing with that return to work program. Don't just check the mark and say, yep, I can return to work, especially if you're someone that maybe really hasn't had much losses over the years and you've never really even had to think about what it is to return employees to work. So really knowing what you can accommodate, how you can accommodate an injured worker and be able to get them back to work as reasonably as possible. Review that program again on a regular basis with your employees, with your management staff, know what that looks like. And then when it comes to claims reporting actions, really reporting all claims. Because late reporting does generally and statistically show that greater injuries or greater claims are paid out with those injuries. So knowing what your claims reporting process is, knowing that employees know how to report, that management knows how to report, that it does get reported to your carrier in a timely basis as well too. Those are really keys to, proving that you're ultimately a better risk.
So basically, I do these things. I make sure I have a safety program. I bring people back to work when they get hurt. I report all my claims, and that's my A+.
That's definitely an A+ on paper. Unfortunately, I can't say that just because you have those things, that's going to ensure that you get the max credit. It's going to put you, above. You might still be on the higher end of scope for your risk. So even with these things in place, it doesn't necessarily ensure that the best pricing is going to be given to your account, but it's a factor that is a great starting off point as well too. And of course, everyone wants to work with the best. Everyone wants to work with the clean accounts, the customers that don't have a lot of losses. But, honestly, we're in the business to write risk. And RAS is really willing to partner with many companies that perhaps have seen some struggles when it comes to losses. And many times it's your willingness to become better, to work with our support staff to improve, and focus on what you're able to do to keep employees safe that we really consider a true partnership.
Thanks, Lisa. Thank you for not throwing too many acronyms or too many tough terms our way. Does anybody have questions? Or again, reminder, you can go ahead and put those in the Q&A. I saw one out there that we can take a look at.
Yeah, I'll jump in on this one here. So it's a great question. And the question is, does work comp claim that does not lead to any medical visits affect your work comp premium? And the example that was given is you file a work comp claim for someone who got a bruise but never goes to the doctor. They simply healed over time and nothing bad came of it. That's, again, a great question. And let me kind of explain a little bit more. So there's a difference between a first aid only claim, a medical only claim, and an indemnity claim. And in this case, we're talking a first aid claim where essentially it was just reported. Again, nothing came out of it. As a carrier, we do not report those to the Bureau, so they do not have an impact on your experience mod calculation. The med only claims, they have actually built in because of the experience rating adjustment that most states are filed for, med only claims will actually only reflect 30% on your experience mod. So they're reduced by 70%. And those are the claims that don't involve any sort of lost time. And because of that, they're significantly reduced. And then you have indemnity claims, which do involve the lost time and are considered at 100% on the experience mod calculation. So they have a bigger impact. So you gave this example. I'm going to add just a little additional example as well, too, that kind of going back to that example I had of a tripping hazard, right? So say you have an employee that falls and sprains their ankle and cannot put weight on that ankle for the next 2 weeks. And you're thinking that's a little bit of just a med only claim. But if you can't return them to work, that becomes an indemnity claim as well too. And 100% of that indemnity claim, which might end up outweighing the med only part of that claim, is going to significantly impact your experience mod in that case. So.
Very good. Another question just popped up, Lisa. Can you talk a little bit about the 3-day waiting period regarding work comp?
The 3-day waiting period regarding work comp. You know, honestly, Kelly, you might even be able to help me out with this one here a little bit too, because we're talking specifically a claim that has occurred. So do you want to jump in?
Right. Do you, really, it's mostly a claim question and it's based on your jurisdiction. So even kind of as that relates to underwriting, there may be some different factors that play in here, as Lisa was talking about, just the different types of claims, whether something is a medical only or an indemnity claim, that could sometimes be impacted just based on the state that you live in and what the laws are there to say if that's something that ends up staying med only, or if we end up with some sort of lost time payment just because of the different laws about waiting periods in that specific state. So if you have more questions, or if anyone has questions specifically about any of the waiting periods in your state, just let us know and we can follow up with you individually on those things too.
Thank you so much for the questions. Great, great.
If there are no other questions at this time, I'll give you a minute to put those in the Q&A for any last minute questions, see if we can stump Lisa here. There is one, and this one's just kind of talking a little bit about the overlap. So how does a work comp claim work when there's a vehicle accident and your liability carrier is also involved? This again is maybe a little bit of a claims question. I don't know if you have anything to add to that, Lisa, from the underwriting perspective, just in terms of how an underwriter evaluates that risk. Maybe I'll throw a little bit more background in here if this is the desired direction that we're going. But as you're looking at maybe a claim that has already occurred and trying to evaluate the risk for that particular employer for a fairly significant claim, that maybe was a motor vehicle accident where you had the work comp portion, but then also liability carrier involved from the perspective of underwriting and just evaluating the risk, if you have anything to add to that.
Sure. Yeah, so I think you're hitting it right on. You know, it's a very deep claim question as to how that involves work comp there as well too, and case by case basis. I would say from an underwriting perspective, the question that I would really have as I'm looking at losses that involve motor vehicle accidents is what exactly does that exposure look like? How frequently do employees travel by vehicle? How far are they traveling? Again, the frequency of it, is it a day by day? And so again, that kind of goes into that evaluating and reading information exposure there. But yeah, so, and there is one question here, and I do want to jump in on this one, and this probably be our last one here to take, but can we discuss a little bit more about ways to start a safety program or a return to work program for your company? So if we have a school district that's looking to start a safety program, where are the best avenues to start? So something that RES does offer free of charge to all of our customers is something that we call eLearn. And it is an online learning tool. And there are specific course and curriculum that involve all kinds of different things that can help with that safety program, developing that safety program and utilizing it as a resource in that as well too. So that's available to all of our customers, regardless of size. And it's something that we're able to track and provide back to the insured, back to the agency as to how it's being utilized. And I do know that we already have a very specific curriculum built out for school districts. So that's a tool that we have. The larger accounts have some additional resources with our loss control staff that we are able to help in building out some safety programs as well too. And that's a resource that we have available to our clients as well. Kelly, if you have anything additional to add in that space.
Yeah, I think that's a great segue. So in addition to just maybe offering a little bit more on the return to work piece that Lisa talked about, as well as the resources that we have, not only will you get a quick survey link that will pop up as soon as we close out the webinar here, which I would love to see you provide some additional feedback as far as just future courses that we might want to consider for webinars. But also you'll get a follow-up email that has not only the recording to today's webinar, it will also have some links and then some direction to provide as far as using our RAS portal. So if you aren't familiar with that, it will have directions about how you get there or how you get signed up if you don't already have access to that. We have lots of different tip sheets and best practices documents there that are really designed to help you kind of get going if you're starting from scratch with a return to work program or a safety program, and that can kind of get you kickstarted in the right direction. So another plug for you to please take the survey that you see pop up at the end here. It's super short. It's 7 questions. It will take you just a minute to go ahead and fill out. And as we plan for future webinars, that really helps give us some feedback about what's valuable for you. And we just thank you for attending today. We look forward to seeing you all again very soon. Thank you.
Thank you.